we're really pleased with the outcome of the EQT 10 fundraising. Reaching the hard cap and increasing the fund size by 40% is a strong result in any environment. But to be able to do it in a tough fundraising market like the one that we've seen over the past 18 months, I think is really a huge achievement. And it's a reflection of our strong track record, investors' confidence in our platform, our thematic investment approach, and our ability to continue to perform. We also think now is a good time to invest. Over the past couple of months, starting Q4 last year, we did see a pickup in deal activity, and we expect this to continue in 2024.
Yeah, and when you say it continues, then I mean Europe, US versus Asia. Where does the focus kind of lie then for you?
So in EQT 10, we're really doubling down on our thematic investment approach, and we continue to see the most attractive opportunities in our prioritized subsectors in healthcare technology, tech-enabled services. We buy globally leading companies in those target subsectors, so we're less focused on where those businesses are headquartered. And if I look at the EQT pipeline right now, we have an equally attractive pipeline across the US and Europe.
Christian, I can't help thinking that the reason why the private equity market, I'm not talking about EQT, I'm saying why private equity generally can't find an exit on public markets is because it's not realistic about what pricing it's trying to achieve for a lot of its assets as well. With that in mind, I know that your company last year talked about the unreliability of exit investments in the current environment. Has that changed now? The public markets have stabilised, have they?
Good question. So what we are seeing at EQT is that interest rates have normalized and stabilized at a higher level. We're also seeing that the uncertainty in relation to the economic outlook has come down, and so what this has led to is just a pickup in investor confidence and a strengthening of capital markets, both equity capital markets and debt capital markets. And they're when it comes to exits and monetization strategies, we're always evaluating all options. But what we are seeing right now is real signs of the IPO markets potentially opening up again. So what we're focused on is making sure that our larger investments continue to perform, the ones that we've held for a little bit longer, and that they are ready should that IPO window really open up again.
Per, I might have called you Christian earlier because I was looking at an article with Christian Sinding. I apologise, of course, the EQT chief executive. You two are completely different. I've seen a picture. But in terms of, I do want to pursue that a little bit more. Look, if a stock is good enough and its credentials and growth are good enough, it will fly in any market. You know this way better than I do. If it's an Nvidia or an Arm Holdings and the profile's right, the market will fly. Why is it that private equity fails to observe this rule, that actually if you price something at the right level, it will go regardless?
I think that's true. There's an element to that, right? And there has been a discrepancy in terms of valuation expectations from the both actually in the public markets and in the private markets, right? Which has led to a slowdown in deal activity, and that's what we've seen over the last 18 to 24 months. But we see that bid-ask spread actually now converging, and that's why we're also seeing a pickup in deal activity, both in the private markets, but also those encouraging signs when it comes to the IPO window. And of course, our businesses operate in the most resilient, attractive sectors. We future-proof them during our ownership period. So I think they should all be attractive IPO candidates once the markets truly reopen.